Today I'm going to show you the most common mistakes that long distance real estate investors make. Not only do these mistakes suck, but they can cost you time, money, and even a few gray hairs. By the end of this video, you're going to know exactly how to avoid these mistakes and make sure your long distance real estate investments are profitable and stress-free. Mistake number one, choosing a market for the wrong reason. The first mistake that many long distance real estate investors make is choosing a market based on subjective reasons rather than objective reasons. Some investors choose a market because it's a popular spot for family vacations, or maybe because they went to college or even university in that city. Or even worse, they choose a market because investors have been hyping it up in a Facebook group or on social media. Now, don't get me wrong, it's important to have a connection to the market where you're investing, but it doesn't and it shouldn't be a personal connection. Good investors know that it's crucial to choose an investment market for objective reasons and not subjective ones. Choosing a market based on the wrong reasons can lead to poor investment decisions and likely lower return. Like if you choose to invest in a fun city like something like Las Vegas, but you don't understand that you bought in a bad neighborhood, this could lead to many difficulties managing the property, lower appreciation, and worst of all, so many headaches. To avoid this mistake, make sure you take some serious time and go through the market, conduct some real, actual research. Look at things like the population growth, the local economy, job growth, crime rates. All of these stats are important. You can also consider the rental demand, average rent prices, and other indicators of the market before actually investing. Let me show you what I use to make sure that I'm always picking the best investment market.
This is exactly the template I use when I'm looking at long distance real estate investing in different cities. What I do is I put the cities on the top and I put all the criteria down the left-hand side. I'm looking at 3 cities in Ontario, Canada, and this is how I break it down.
Mistake number 2, accepting mediocre returns. Some investors try and justify paying more for a property because it's turnkey or newly renovated, or worst of all, already has a tenant in it. Be careful here because this is a trap, and you may end up actually overpaying for an underperforming property, and nobody wants that. As investors, never pay for future potential, and don't let a seller talk you into it. Just because the seller tells you that you're gonna get a great price 3 years down the road when you sell, or that the rents can be raised a couple $100 each, this doesn't mean that you, as the investor, have to pay extra for the property. In real estate investing, money is made by buying at the right price to maximize your overall returns. As long distance real estate investors, I always run my numbers to make sure the property that I'm looking at generates positive cash flow and a good return on investment 3, 4, and even 5 years into the future. Now here's what you do, it's super simple. What you need to do is run your numbers on dealcheck.io and see the metrics that are important to you, such as cash on cash return, return on investment, or even better, return on equity. For myself, I like to look at cash flow like this. If I'm looking at a single family home, minimum $200 a month in cash flow. And if I'm looking at a multi-unit building, I'd go with a minimum $150 a month for multi-families. And if we're talking about return, listen, I'm not even getting out of bed for less than 20% overall return. Take this in. You can invest in stocks like the S&P 500 and get a 10% year over year just sitting at home on your couch. So if you're gonna take on the challenge that is long distance real estate investing, you better believe 10% is not gonna cut it. I'm looking for minimum 20% return or it doesn't make sense for me going through it all. Remember, you make money in real estate in so many different ways, not just cash flow alone. By buying properties below market value, by either negotiating a good price or finding a good off-market deal, you won't have to settle for mediocre returns. Now, if you can toss in a little appreciation that's either forced through methods like the BRRRR strategy, or even if you're relying on simple, steady market appreciation, your tenants are still gonna pay down that mortgage over time, and you'll see why mediocre returns are meant for the stock market and the real wealth is built in real estate. Mistake number 3, depending on your family members. Now listen, I hate to see this, but the third mistake that so many long distance real estate investors make is depending on family members or friends to manage their long distance property. Now, choosing a long distance market just because you have a family member or a friend that lives there can completely throw off your numbers, and it should be avoided at all costs. As long distance real estate investors, you're running a business because you're a business owner. This is not a hobby and you need to run it as such. You need to budget properly for repairs and maintenance as well as property management. and make sure that you're hiring a trusted team to handle all aspects of your long distance real estate investment. Now, if you're gonna self-manage your property remotely, still budget for like 3 to 5% of your rental income to cover your time and your management expenses. And if you're gonna go with a property management company, make sure you're budgeting like 8 to 10% of your rental income to cover their services. And listen, if your deal doesn't seem to be working out on paper with these new property management expenses, I'm giving you permission right now to walk away. This goes back to mistake number 2. We don't accept mediocre returns. So if your numbers don't work, move on and find the next deal. It's important to start changing your mindset here about pinching pennies and using your family and friends to help you manage your long distance real estate rental. You gotta see the trade-off here. With long distance real estate investing, you need to pay to have a team in place to run and manage that property effectively. But at the same time, you get access to new and emerging markets, ones with better cash flow, better appreciation, and better overall returns. My man David Green from Bigger Pockets always talks about the core 4, which includes a realtor, a property manager, a contractor, and a lender. My advice, find your core 4 and rely on them. But also check out his book on long distance real estate investing. I'll put the link below because honestly, it's a banger. Avoid these 3 major mistakes and you will avoid losing time, losing money, and maybe even a few gray hairs up top. And if you want to learn what it takes to become a long distance real estate investor, check out my other video on the screen. It's Isaiah Henry, your favorite long distance real estate investor, and I'll see you all on the next video.